Good afternoon, everybody. I'm welcoming you to our webinar today. My name is John Goki. I happen to be the moderator. I'm a homeowner, and proud today, happy that CII Illinois can get 3 additional wonderful, excellent panelists that hopefully will elucidate everything you need to know about how to enhance the value of your biggest investment, which is your home and your association. So I'm going to ask the panelists one by one to give their name, their introduction, brief bio, and what area of expertise they have. I'm going to start as the moderator. I'm picked as the moderator because I'm a homeowner and the secretary of the Westchester Club Board of Directors in Westchester, Illinois. I've been a member of the Homeowners Education Committee for about a year, and I've had the pleasure of working with Steve Silverman on that committee, who's also a committee member, who will be the next person we ask to introduce themselves. So, Steve, you want to introduce yourself and then turn it over to Peter and then to Joe.
Okay, sounds great, John. Yes, my name's Steve Silverman. I'm with the accounting and consulting firm of PBG Financial Services. I have been involved in this industry for now over 40 plus years, which is hard to believe. We work with Condominium Homeowners Association, both in Illinois, Wisconsin, Indiana, and Michigan. I have been very involved with CI Illinois. I've been on the board of directors, as a matter of fact, the board of directors with Pete. I've been treasurer of the association, and I've been co-chair of the finance committee for God knows how many years. So this is a fantastic organization, and I'm happy to be involved in this seminar today. So go ahead, Pete.
Good afternoon. I'm Pete Santangelo, and I'm president of Wintrust Community Advantage.
I'll get it.
Division of Wintrust Financial Corporation, a multi-billion-dollar holding company. I have over 35 years of banking experience in various aspects of banking, but I've been concentrated in the condominium association niche banking for 19 years. I belong to various organizations within this group, including CAI, ACTA, and IREM. And I also hold my CMCA, which I've had for over 18 years. I'm a past president of CAI. I was the president in 2008, and I'm on various different CAI boards, including ILAC. And I'm the president-elect for the board of the CAI Foundation for Community Association Research, and glad to be part of the organization and here today. Jill?
Thank you so much. My name is Jill Daniels, and I'm a real estate attorney, and my firm specializes in residential real estate transactions. And while my firm's located in LaGrange, we, do closings all over the north, like outside of the all over the Chicago metropolitan area. And I'm so honored to be asked to be part of this discussion. I do find in that so many of my buyers and sellers have a condo or homeowners association as part of their purchase. And a discussion like this is really good for everyone involved, just to know what is involved with buying and selling your home in a homeowners condos association. Thank you so much.
Jill, thank you. Jill, you're also a licensed real estate agent, aren't you?
I am, but I don't practice it. I just do it so I can teach.
I understand. Well, that's a great credential, and another reason why we selected you for this panel. I just want to make sure you got proper credit for that.
Oh, thank you so much.
We have a lot of topics to cover, so we're going to get going real quick. But I wanted to kind of steer it towards, since Jill was the last one to introduce herself, I wanted to steer the first question towards Jill, because the question has come up, of course, we've got concerns about all kinds of things that can affect the value of your house besides what you put inside of it. The wonderful furnishings and the landscaping outside are not what we're going to be talking about today, but all those other variables that can impact the value of the house. One of those happens to be the actual sale or the product of what you're trying to sell. And during that time, there is some issues about disclosures that have to be made. Jill, can you explain that a little bit?
Sure. So there is a 22.1 disclosure, and what this is that the board of managers or your managing company, for the association would fill this out. So it's really like a snapshot of the financial picture, if you will, of the association. So it goes through what are your monthly assessments? Are there any other assessments or charges? Because you might have a monthly assessment for $400 that covers your unit, but it might also be where you also are required to pay for the cable as an extra $69 or something like that a month. It also discloses, is there a special assessment pending? Because when you go to sell, that special assessment that might be assessed against your unit would be something that the seller would pay in full, and then the buyer would not assume that. So they would take your unit free and clear, if you will. So there wasn't monies owed. So it also asks you to go over, are there any special assessments currently under consideration? So this would be appropriate to fill out for the association to fill out and say, you know what, we have, our thought is we're going to be resurfacing the parking lot. And we don't know if we're going to charge a special assessment for that or not at this point in time, but that's in the discussions. This is just to kind of educate your consumer.
So is that something you might disclose, an anticipated special assessment?
Well, it does. Well, I wouldn't disclose it as the attorney, but the seller.
No, but correct.
The seller, that would be something, in the way it's like if it's levied prior to the sale, you go under the contract, and then if it's the issue we have is if it's like, let's say you're closing, you go under contract on September 1st, you're closing November 1st, and there's a special assessment discussion, we want the buyer to know about that. Are they walking into something where there's going to be a $20,000 assessment on that unit, in December? So that's where really it's something that does need to be disclosed. And if you are the homeowner that knows about this and you're trying to get out, if you will, prior to this coming, you can run, but you can't hide necessarily. So that's something that the disclosure does happen.
Okay.
And it also goes on. Oh, I'm sorry, John.
No, go ahead.
Oh, no, it also goes on to talk about what do you have any capital expenditures coming up? Like some of them, if you have a really healthy association, you could say, hey, we're redoing the roof on building 3, in November, and there will not be a special assessment for that, because some associations do have, a big plan as to how they're going to do stuff every year. And the next question goes on to say, you have a reserve account. So you have your operating budget and your reserve account. So kind of disclosing that reserve account and if anything's earmarked for that. And they also want, in this 22.1, are there any lawsuits or judgments out there against any of the unit owners? Because I think it's important for everyone to remember, you all own this together with the condo association. This is something that you own together, and what happens to one unit might impact the other units, or will impact the other units. It provides the insurance carrier information so that everyone has that. So it's, like I said, a snapshot walking in.
Right. So in other words, prospective buyers really buying both the assets and the liabilities that are part and parcel of the common property, correct?
Right. And the buyers should be doing their due diligence. And, in the contract, we're using the 7.0 contract for the real estate contract. It does even require the seller to provide certain documents. And I expand upon that in my attorney review letter and ask for some more items that wouldn't be typically, tendered, if you will, pursuant to the contract only.
I think we're going to get to those other items a little bit later in the hour. Yep. But I wanted to turn it over to Steve and ask Steve, what other financial documents or facts besides this required snapshot do you think buyers should be asking, or do they?
Well, that's a great question, John. So first of all, from what Jill was saying, absolutely, the budget is a real key thing. The reserve study is a real key thing. I have so many of my clients that will come up to me and said, Steve, okay, I got this budget. I got the reserve study. What does this mean? I have no idea what's going on here. So what I do is, besides getting that reserve study, I said, I want to see a financial statement of it if you're coming to me. But what my preference is to see a CPA prepared financial statement. And the reason for that is a CPA prepared financial statement usually is a GAAP financial statement, which is generally accepted accounting principles. So with that, and by the way, all associations that have 100 units or more, starting in January 1st of 2018, now have to have generally accepted accounting principles financial statements. But the reason that I want to take a look at these type of statements is, number one, it's on an accrual basis. So this gives me really the association's true financial picture, because accrual basis is showing me when income is billed or earned and expenses when they're incurred. Many times management companies aren't on a full accrual basis, where they might have your receivables and show income when it's billed or earned, but the expenses are usually shown when it's paid. If it's a self-managed association, 95% of the time it's just a pure cash basis. So that's why I like to see the CPA prepared financial statement. Also on these GAAP statements, which is so important to any future buyer, even a current resident, not only does it have a balance sheet and an income statement and a cash flow, but it gives footnote disclosures. These disclosures, and it's kind of what Jill was talking about, gives you more information of what is happening with that association. So if there is a loan, it'll discuss about the loan. If there's any litigation, the financial statement will disclose that. It'll disclose if there's any delinquent receivables, etc. So it's so helpful. The other key thing about these GAAP type financial statements is they're usually on fund financial statement basis. So that's a real key thing, because now I can tell what is operating fund and what is reserve fund, cash and liabilities, income and expenses per fund. And I also can start telling it, are they commingling the two funds, which that could be an issue, because here you've set aside that X amount should be assessed as reserve assessments, and if it never gets into the reserves, you've commingled that. Same thing for reserve expenditures. If they get paid out of the operating fund, instead of getting paid out of the reserve fund, you've commingled your accounts. That's where these type of financial statements help out, because we come in at the end of the year and then we delineate what is owed between the two funds. Very important. The other key thing on these financial statements is on the income statement. So on the income statement, what I like to do usually with the potential buyer or the seller, so they understand what it is before they put their unit up for sale, is I like to look at the expenses and see, here's what actually happened, here's what your budget showed. Why are there differences? Okay. Why could be more repairs than what they budgeted? We want to know this, because especially if you're buying into a unit, you want to know, why was all of a sudden there's some additional repairs? Did something happen? Did you not budget for something? Did you not renovate something according to your reserve study? Real key thing. Same thing with your reserve expenses. If they budgeted certain reserve expenditures, but I have other expenditures in there, or the reserve expenditures are more than what they budgeted, again, that's another thing that I want to find more about to see how that's going to affect the potential buyer. Because if they're so far off on what the reserve expenditures are right now in this statement, what are they in the future? And we're going to get more into the reserves a little bit later. The other key thing is on the balance sheet. I always like to take a look at cash. And one of the key things that, I tell future buyers is I'd like to see 1 to 2 months of operating cash on that balance sheet. That way I know if there's any emergencies that come up, or you have higher than expected expenditures, if it was a bad winter, now you got a little bit of additional operating cash. I also like to see, of course, what that reserve cash is, and we'll get into that a little bit later on. But what I also ask unit owners, or, that I like the potential buyers to find out is there an investment policy? How is that association investing their funds? What is the priority? Is it safety? Is it liquidity? Is it yield? So then they have a better idea. Does this meet what they really think they want to get into. I mean, is this philosophy something that they're okay with? Or is it a too aggressive a philosophy? And maybe they're going to say, well, I don't know if we want to get into this association. One of the other key things is receivables. And I know this is something that Pete looks at all the time. So I want to turn it over to Pete so he can give his opinion more about when he's looking at these receivable balances.
Yeah, thanks, Steve. I appreciate that. Steve brought up a lot of good points as to what you'd want to look at when you're buying into an association. But receivables are, very important as to, how is the association, do they have a collection policy? How are they being received? How are they being paid out? I mean, that's an important factor. He mentioned a loan. On a loan, is the loan being repaid out of the operating budget? Is it being repaid from the receivables through the special assessment or not? I mean, these are all questions. I don't know how in depth of information you're going to get when you're buying into an association. But I think, the points that Jill and Steve brought up are very important, especially the reserve studies, which we're going to delve into a little more in detail as to how that can impact when you're buying into an association.
Great.
So Pete, now that you've kind of talked about that, I mean, the other thing I look at is payables too, because I want to see, what are the operating payables at the end of the year? Are there just timing differences? Is it because they're having financial difficulties? I want to look at some of the reserve payables too, because what I really want to know is, are they in the middle of a reserve project? This kind of tells me where they're at on any type of big project. So are they in the middle of a project? Are they just ended the project and they still owe money? This is where it starts getting me more questions to start asking, which is so important to know where you're at with any of these reserve projects when any future buyer wants to buy something. But the last key thing on that balance sheet is the bank loans, which you started to talk about a little bit, Pete. And maybe you can go into a little bit more, not only on what you look at in order to loan associations money, which is an extremely important part, but going back even on the receivables, because I know that's one of the things that you look at is, what percentage of those receivables are collected.
Yeah, okay. So when we're looking at a loan, I mean, there's certain aspects that we'll look at, as Steve mentioned, the receivables, but we're looking at, again, the current budget. We're going to be looking at the financials, as he brought up. We're going to be looking at how they're going to be paying for this loan. Is it going to be paid for out of the operating budget, which would be their contribution to reserves, or special assessment? Who they're owing who they're making payments to. Are they paying on time? These are all aspects of what we look at when someone comes to us, for a loan. And the biggest impact that we will look at is the reserve study. Because the reserve study is going to show what expenses they currently are going to have that will be upcoming, and what will be taken care of from our loan that we're giving them on the reserve study component. So what we'll do is a cash flow analysis. We'll look at, what dollar amount they're asking for us for the repair replacement of the component they're going to be doing. And then we'll look at, over the time frame of the loan that they will have with us, what other components will have to be repaired or replaced while our loan is in place. Because we want to make sure that they're going to have sufficient cash to pay back our loan.
Steve, and I loved all three of you commenting on this. I wanted to ask Steve and Jill a specific question about their clients, if you will. Pardon me, my throat. First question, Steve, what percentage of your clients come to you and say, boy, I'd like you to look at the finances of this association before I buy.
If they're my clients and they're taxpayers that I do their 1040s or people that own businesses, and I even have some people that are unit owners, probably a good percentage of them come to me to ask me that question because they are so concerned. Because I think as we've kind of talked about, this could be one of their largest assets that they own. And what happens is, I think a lot of people are concerned. I think they're even more concerned in this day and age that, hey, if they're buying something and this could be their largest asset, they want to buy an asset that's going to continue to grow. What we're talking about right now are so important. These reserves, having good financial statements. This is so important in making a decision on something that could be your retirement asset when you decide to retire.
Jill, similar question. What percentage of your clients ask you specifically, hey, I like this townhome or I like this condo? Take a look at the reserves and tell me all about the reserves. Am I buying into a good place or not? Can you answer that, please?
You're on mute, Jill.
You're on mute, Jill.
Sorry. I'm involved typically after they have a contract. So it's part of my attorney review that I put in my letter to the other attorney. So if you're looking at me as a buyer's attorney, it would be something I would put in my letter with the list of things that I would ask for. And as we receive those in, we send them on to the buyer, and I'm always happy to discuss it with them. The things I hone in on really are the budget, or the 22.1 and the paid assessment letter, and really always put it out to my client. Hey, do you want to talk about this? And I would say more than half, when they get the documents, have additional questions. And it might be a question I can't answer, or we kind of go over it and discuss, what does this mean to you? There might be a special assessment coming up. What does that mean to you? How is that going to impact you? Where are we at with this? To make sure that they're comfortable, because there's, typically like 5 days that you have to review the documents. And if you disapprove of them, even if we get something a week before closing and we're all ready to close, and my client disapproves because this association's not sound, that allows them to cancel their purchase. So really, I would say, circling back to the specific question, is probably more than 50% of them want to know more detail, want to have those questions and look at them.
Hey, Jill.
Is it routine?
Question.
Is it routine then, Jill? Excuse me, Steve. Is it routine then, Jill, that you ask for the copy of the reserve study for all of your buying clients?
I do, absolutely.
Okay, thank you, Steve.
And Jill, just as a follow-up too, how many of your clients, when you are putting together documents, how many of these associations actually have reserve studies? Or the bigger key question is, even if they have one, do you ever look to see, is it 10 years old? Is it 15 years old? Or when was the last time it was updated?
I'm going to say not many have them. It's really, I'm going to say more times than not, they don't have that reserve study, and it's not current when we have them. It's something that I feel personally that a lot of associations wing it, if you will, and there's not that proper planning for it. And, I'm surprised actually when I see one and it's a current association, current reserve study.
Well, I'm going to throw this next question out to all three of you and see what you have to say about it, because it sounds like reserve studies are a good thing to have. It sounds like a lot of associations maybe don't do it, or don't do it often enough, or update it often enough. But the bigger question, I think, is when you get a reserve study, how do you all evaluate an association vis-a-vis how they're reacting to it with the reserve budgets, et cetera, et cetera? Because getting a reserve study just means the study is done. It means nothing if the association doesn't have one.
You want to take it first, Pete?
Sure.
Pete?
Reserve study is vital to what we do. If someone's coming to us for a loan, it's going to tell us the projects that are upcoming, while our loan will be in place, and the scope of work that needs to be done with our proceeds for our loan. So Steve brought up a key point. What we see is, I think, not trying to segregate out, but most professionally managed associations are getting reserve studies for their clients because they understand how vital it is. And just because you have the reserve study, there are certain situations that impact how you fund, and I'll let Steve talk to it. But, like COVID, maybe you had a project that was supposed to be done this year, and because of COVID hitting, you can't do it or don't want to do it and prolong it out, a little bit longer because the work does not really need to be done right now. But reserve study is very important, and it's something that I look at when I'm looking at an association, that and the financials to see, how are they funding towards it and what projects really need to be completed. Now, with that said, there are a lot of self-managed associations that are getting reserve studies and are up on top of it, making sure that they're fully funding, or at least funding as best they can, their reserves.
Pete,
we had a question from someone who sent it in. I wanted to direct it at this point to you. What should an association do if someone asks, how well funded are your reserves? Well, what's your percent funded? And we're going to actually ask Steve to describe percent funding here in a minute. But how do you handle that? How do you handle that question from a disclosure standpoint? If someone wants to know, are you 10%? Are you 50%? Are you 70% funded? What should
I guess you'd have to look at exactly what your reserve study says. But again, within the reserve study, you could, or the board should be commenting on why they aren't fully funding or why they're pushing off projects and they feel that they are taking care of the projects that need to be taken care of at this point in time based on, again, the reserve study is an estimate of useful life. It's a tool to be used. It's not an exact science. So the board should use it as such and make sure that in their meetings they're documenting, or at least the finance committee, if there is one, is putting in place comments as to why they're not fully funding what reserve study said they should be doing.
Okay. Thank you, Steve.
Yeah, so going on with what Pete said, the first thing is, Pete's saying that he has self-managed associations that do reserve studies. The real key is having a professional do the reserve study. That's number one. When I've had boards try to do the reserve studies themselves, lots of times they are missing certain components, which could run into issues later on, where all of a sudden they're wondering, well, how am I going to fund this? Even when you have a professional study, what I have found out over the years is the board should be reviewing those professional studies when they're being done. So they can ask questions, find out why this is on the study. Maybe it shouldn't be part of the study, or maybe certain items are missed. I have found that out many times. So number one, the board has to be totally involved when they get this study. Then it comes to, again, so that makes sure that's not a faulty study because you're reviewing it at that particular time and you're getting a professional to do it. Okay, once that's done, what you need to update those studies every 3 to 5 years at the latest, but the board needs to review these every single year. They need to look at, here's what happened this year. Okay, is that what the study said? Because like Pete just said, it's an estimate. It gives you a guide. So if it's a guide, you have to kind of look at it and update it every single year compared to what you actually paid out, when it actually happened, and when your reserve study says it should do, and update it accordingly. So then you got into your next question, kind of, John, is about funding methods, okay? And there's this concept of percentage funding. So there's actually different ways of funding. There's what's called a full funding method. That's probably the best because you're always going to be 100% funded. So what does that mean, full funding? That means, let's say you had a roof, and the roof is $100,000. And so you should, let's say it's a 10-year life. So every year you should be putting in $10,000 into your reserves. Okay, so at the end of 5 years, you should have $50,000 there. That means you're fully funding. You're 100% funded. Okay, that's what full funding is. There's also something called baseline funding. So baseline funding basically is saying that you're going to fund reserves and just make sure it never goes below zero each year. Okay, and there's also something called threshold funding, where you pick out a number and you say, hey, for funding reserves, we don't want it to go down below a certain number. What percentage funded basically mean is how much do you have in reserves compared to how much money you should have in reserves. So it's basically looking at, okay, if you're going to be 100% funded on each of your different projects, okay, so let's go back to this roof. So let's say after 5 years, and it's a 10-year life for a $100,000 roof, you should have $50,000 in there. So that would be you're 100% funded. Let's say you only put in $25,000 after 5 years. Well, now you're only 50% funded. So maybe if you still have 5 years to go, being 50% funded isn't the worst thing in the world, but it's not good. So now you got to figure out how are you going to have enough funds to be able to get enough funds in there by the time you're ready to do that project. So I'm just using an example of one particular component. Many associations have many components. So when you're looking at it, you really have to look at all your components. What are the lives? What are the funding requirements to have enough money in there by the time you have to replace those? If you have so many components, and let's say they're spread out over a long period of years, you might be okay with a lower funding percentage. So maybe 50 or 60% is fine. Or maybe you just did one of your largest projects this past year, and you could be down to 30%, but you don't have any other projects coming up for a while. Well, then you might be okay, and you might have enough funds going forward. So a lot of people think, well, if I'm 90% funded, I'm always good. Well, I just had an association. They were 90% funded on a roof. Okay, and it was time to do the roof. So that meant on this $100,000 roof, they had $90,000 paid in. So they were still missing $10,000 at the time the roof had to get done. So what happens? They don't have enough funds to do the roof. Sure, if you have reserve funds for other projects that are in there, then you use the money that supposedly is for other reserve projects. So I guess what I'm getting at is percentage of funding doesn't really tell you the true picture. You really have to, as Pete was saying before, you have to do a cash flow method. You really have to sit there and plan it out. You have to say, okay, here's all when my projects are coming due, okay? And I always tell association, look at least 5 years ahead of time. We want to know with these projects coming up and what you're funding, are you going to have enough funds for these particular projects? And the cash flow method is always the best way to look at it. But you got to look ahead. You can't make this decision at the last minute, because what's going to happen if you wait to the last minute? I'm going to Pete and I'm going to ask Pete, hey, Pete, I'm going to need a loan. Guess what? I don't have enough money to fund these projects.
Well, not only that, the reserve study doesn't reflect any legislation that may be passed, in the township or where you're at. Like, you're doing your reserve study, and then you have a life safety issue that was measured. Well, that component wasn't part of your reserve study. So now, what do you do with it throws your funding, upside down. So that's why your cash flow really would take into account, okay, here's what's upcoming, here's what we have to do, and here's how we're going to take care of, this life safety issue that we need to take care of right now.
If I could interject a question for the three of you at this point, I'd really love to focus in on this topic of reserves and planning for the future and different ways to fund the future, if you will. Because this is really what it is. I mean, if you have a home and you have ownership in the common elements of part of an association, funding and planning for the future is as important as funding and planning for today. So looking at this, two questions for all of you. What do you think, going forward, an association should plan to do? Is it best to mostly fund their future expenditures through reserve,
funded through dues by having just dues increases, or
a combination of the two, or special assessments as the last resort short of a loan? I mean, there's really 4 different ways that I can think of funding. And I'm going to ask each of you to go through in your own mind which might be the best in most instances for homeowners associations and funding. Pete?
Well, of course, full funding is the best. I mean, if you're full funded and you have the cash, you're going to pay for the project. But as I was talking before, life changes, things happen, so you possibly may not be able to fully fund the reserves. And again, you have boards that come in and have different philosophy as to how you will, fund these projects. So I guess what you need to do as a board is look at where you're at, look at the cash flow, and as an association, you only have, the ability to raise capital by implementing a special assessment, increasing your regular assessments, taking it out of your reserves, and taking out a loan or the combination of any of those 2 or 3. So I don't think there's one succinct answer, but fully funded, to me, obviously, is the most favorable one.
Okay. Steve?
So it's really a combination here. I mean, when you start talking about special assessment is a very, very negative item, especially a negative item if you're a future buyer coming into the association, as Jill can talk about. So when I'm looking at this, and I've got an association right now where I was just hired. They had a reserve study that was done over 10 years ago. And so now they're calling me and said, Steve, I think we need to go out and get a loan. We've got these big projects coming up. And so I said, okay, we're going to take out this loan. What do we do now? Okay. I said, it's not just taking out the loan. I said, now you're going to take out this loan. Can you afford to pay back the loan? And, many times, as Pete will tell you, is they take out a line of credit for a year or 2 years so they can help fund it, and it's interest only. So that part's easy. But now you get into the part where you have to pay back principal and interest. And now you got to make the decision. Do you have enough funds to pay for the principal and interest going forward? And how do you continue to fund for future projects? So now you got to go out to a special assessment. So once you start going out to a special assessment to these unit owners, how much is that special assessment going to be? So again, this comes back to your whole cash flow situation that I talked about before, because you want to try to do the smallest special assessment that you can to the unit owners. So it's not something that hurts them. It's not something that all of a sudden they're going to say, okay, I have to sell this unit. I can't afford this. If I get hit with a special assessment now, what am I going to get hit with later? So that's where I come back to saying, okay, if we have to take out a loan right now, and if we have to do a special assessment, which we hope we can keep down, that's where we come back to the cash flow. And so now we have to go and start looking at the future here and saying, okay, if we borrow this, and we're certainly not going to go back to Pete and say, by the way, Pete, I just borrowed, $300,000 or $500,000 for you a year ago. 2 years later, I need to borrow another $500,000. He's going to say, well, no, you didn't do your proper due diligence, as he was talking about before. So that's why these associations, you have to do this cash flow, where now you have to set up what are you going to start paying over these coming years, and knowing how much can you afford to pay on the loan, how much are you going to get back in your special assessments, and how can you get back to where you're properly funding for your reserves in the future, because that's what a potential buyer wants to know. They want to know they're not going to get into a situation where they're going to get hit with a special assessment a year or 2 years. And I know Jill was talking about before, well, you should be disclosing if you think there is going to be one. But I've gone with a lot of associations. They have no idea whether they're going to have to special assess or not, because they're only looking at year by year. Right. What is your opinion, Jill?
And Jill, before you answer that question, I wanted to jump in with one very similar along these lines from a homeowner, and that is, what do you think impact buyer's psyche more? The specter of a large special assessment or the specter of higher monthly dues?
I think if you have a sophisticated buyer, they would be more concerned about the special assessment. But I'm not sure people fully understand it because there's a lot of liability associated with that special assessment. Not everyone can budget for a $20,000 spend. And even if you give your buyer, your homeowner, I should say, the option of 5 years to pay that back, I don't know what that math would be, like a couple $100 a month over 5 years, that's great until they need to sell. Because if they need to sell, that needs to be paid in full then at the time that they're closing. And it's really an additional payout or a loan, if you will, on their property. So I think if you really have a sophisticated buyer that fully gets the picture, they would rather have it be funded, have a better, higher association fee, and have that be every month so that you have a solid association. Because the fear of special assessments, not everyone can absorb that. And then if you really are looking at what are the risks of the special assessment, if you have, let's say, 100 units, 5 now can't pay it, then the other 95 have to bear that risk for it. And then
Right.
And then your association as a whole, your investment on the exterior goes down, or you have maintenance issues that they can't address, those kind of things. So, in piggybacking on what everybody else has said, I do agree that a fully funded association is the best way to go, because I think the others leave questions. I mean, it's fully funded better for the buyer, fully funded better for the seller. So you don't have that liability when you're going to sell, and you don't have that risk coming into it about a poorly, because, like if there's a lot of special assessments, we question as the attorney, is it properly managed? That raises a lot of questions. And then when you have a loan, the questions that's raised. Sorry?
But I hear all three of you saying, in slightly different terms, but I hear all three of you saying that a long-term perspective for things like cash flow and where we are with assessing what our future expenses will be and planning for them financially as you go, rather than relying on a loan or relying on a large special assessment, tends to be the better road to travel. Is that a fair summary of what I've heard the last 10 minutes?
Yeah.
Absolutely.
Yeah. And one other thing I just wanted to mention, John, too. I mean, in this age we're at right now, and Pete can talk about it more, but the interest rates are so low right now. So this is a great time to start looking at where you're at right now. And I know people are concerned about whether their collections are going to keep up to where they should be and everything. But what I've talked with some associations about is maybe this is time to take out a line of credit, okay? And you have that just in case something is going to be coming up here in the future. So that at least you know that, God forbid, if something happens, you have some additional resources to go after. And I don't know how you feel about that, Pete.
I think it's good for some, but not good for all, because you still have to have the cash flow to be able to pay it back.
Right.
So, I mean, it really depends on each association's financial picture as to whether that would work for them. I mean, the same thing with the question of should we special assess or should we increase assessments? There are some associations that want to keep assessments low and would rather, if you're doing a one-time special assessment, would rather do that, get it done and over with, and keep the assessment low going forward, as long as the assessment, once that special assessment's paid, will take care of, again, it goes back to cash flow, will take care of the upcoming components that need to be repaired down the road. But, I've known some associations that don't want to put funds away into reserves, and they're a higher end association, and they continually will special assess all the time, and unit owners don't care. So again, it's not the prudent way and the best practice way of doing it, but I think every association is a little bit different.
See, but what I think, hold it, John, one sec. What I was just going to say is, what I see is when I have somebody buying an association for the first time, they're not even thinking about special assessment. The only thing they're looking at is what is my assessment and how does that compare to the assessment? And Jill could probably say this too. What does this assessment compare to this other property that's right by or this other association that I'm also thinking of? So if I'm looking at a future buyer, they're not even thinking about special. It's not even on their mind. They don't even understand that. The first thing I think they're looking at is, hey, what is that assessment? Can I afford that assessment right now? Now it's up to them to do their due diligence to find out, as we talked about where you're at with reserves, et cetera.
Right.
Well, realizing that every human being, at least every human being I've ever seen and talked to, wants to get the most for the least all the time. But realizing also that you have to pay the piper at some point. In your assessment, I'm going to throw this out first to Steve and to Jill, but you can come in later with this. What percentage of associations that you have seen do you think are adequately funded given how their reserve studies look on the road?
Well, I'm going to go with first, do they have a reserve study? Because we don't know if they don't have one. I'm going to say most of them that have a reserve study are much more financially sound. So if you're going to look, I mean, from my perspective, not, a layman and compared to all of you here, if you will. But if you're going to look at, once they have a reserve study, they've made a lot more steps that a lot of other associations have done. Is where I think that's a good sign to point that they're trying. They're at least aware of it, because you might have another association that doesn't have that and they have a lot of money in the bank, but we don't know, do roofs need to be redone? What are they not even anticipating, because there is no reserve studies? Let's just say they have 100,000 in the account, but we don't know if it's going to be 300,000 in the next 3 years that needs to be spent. So it's really relative.
Yeah, and it really depends upon, in my opinion, on two things. Number one is, are they professionally managed? Because having that professional management does help them out, does keep reminding them, hey, this is something that you need to do. You need to get the reserve study. You need to be funding this. That helps out compared to a self-managed association. But saying that, it also depends upon the board of the association. I mean, if you have a really good board and their main concern is how do we keep their main concern is about the future of the association. How do we continue to keep our association looking beautiful? How do we make this as the top of the line for anybody in the neighborhood that comes by and sees us, that this is the place we want to go to? So you have all different types of boards. Some boards only care about keeping the assessments low because maybe they only want to be there 3 or 4 years. But it could be in those 3 or 4 years, all of a sudden you run into some problems with your association where all of a sudden you got to do some major renovations. And all of a sudden here, your thought process, I'm going to be here for 3 or 4 years. I'm going to sell my unit. I'm out. I kept those assessments down low and I'm in great shape. But it doesn't always happen that way.
Pete, I wanted to also ask a question about depreciation, because one of the comments you made about boards of relatively high-heeled or well-heeled associations might want to artificially depress their dues because they know most of their owners can afford large special assessments. But most associations are a mix of people, and that isn't the case with most associations, I wouldn't think. So, given that reality, I'm thinking here, what about the saleability of a residence, say 5 years down the road from now, if all of a sudden you're responsible for the road and you have to spend $1 million to repair roads? Is it fair that a new buyer be socked with the equal cost for those roads as someone who has driven over them for 20 years? I think there's
it's not
equity
fair.
issue.
It's not fair, and that's not the best practice way to do it. That's what we said. A fully funded reserve study would be the best way of handling it. But in reality, you have different boards, you have different philosophies, you have, different struggles that may happen. Like I mentioned, COVID, which, some people maybe are struggling and our delinquencies are going up, so they can't fully fund their reserves. So, in answer to your question, is it fair? No. Fairness, you should pay for what you used. It should go in there. But in reality, that's not how it always happens.
Okay. Well, we're at, I think, 5 minutes to the hour. And I'm wondering if each of you have just a brief comment or two for maybe 60 seconds, and then we can open it up for a couple of minutes to any outstanding questions that might be there from Brandon. Pete, you want to start? Anything to stay in wrapping up?
Review. I think the association living is not for everyone, but if they're well run, there's a lot of people that are living in associations. And to the buyer, I would say caveat emptor, buyer beware. Make sure you're getting all your financial reports. Make sure you're asking the right questions. Make sure you have an attorney that is knowledgeable in association transactions and is he has that background to know what questions to ask and get answered. That's important.
Great, thank you, Jill.
I would just say make sure you download. There's a link when you're viewing this to be able to download the attachments that we've prepared for you. One of them is like if you're a self-managed association, a paid assessment letter, because we find that sometimes that's a big struggle for smaller associations when I, as the attorney for the seller, say we need a paid assessment letter. So we've prepared a sample for you. And then also there's a list of documents that often are asked for during the attorney process of, your seller is under contract. And those might be just, it's not all inclusive, but there's many items there that might kind of, put you on the right path as to what can be asked for, what's typical to be asked for, and just to be conscious of that.
Thank you for reminding us about that, Jill, because CII Illinois, I think it will ask you for your name and your email address in order to get those deliverables. But as you pointed out, I think it's well worth it. Steve.
I guess to kind of sum this up is I recently just saw a survey that was done within the last couple of years. And that's why I thought this seminar was so important, because I saw some of the results of the survey. And the survey they did, which I think was national, basically 81% of the people encountered unanticipated and unplanned infrastructure issues. Exactly what we were talking about, that there was no plan there. 80% said it was critical to them to have adequate reserves. Again, exactly what we're talking about. And 70% of the people said maintaining property value was a primary importance. And everything we talked about today is what really helps keep your property value where it should be. That if you're not looking into the future, you're not looking into the current year, that basically your market values won't stay where it is. So I think this is such a key thing.
Good. We had a question from someone. Jill, you might be able to answer this real quickly in the minute that remains. What if the buyer's, review time has expired, and then during the last day or two you become aware of this reserve study, and by the time you've digested it, your review period has lapsed? Does the prospective buyer have any recourse if they go, whoa, I didn't know about this?
So you have the attorney review process, which allows in the first 5 days of the contract for the attorneys to present what their concerns are, or modifications to the contract. And then we come to a resolution on that. But the homeowners, the condo docs that you would get are a separate review period. So it's a receipt of them. So oftentimes, we may not order the HOA, we might not order these documents in advance because could be a several $100 charge. So once attorney review is wrapped up, the documents will be ordered. It's 10 days, business days for the contract to order them. And then we don't always get them right away. We could order them, and it's great when we can download the link to the rules, regulations, bylaws, those kind of standard things. But the 22.1 disclosure and the paid assessment letter, I have a closing later this afternoon. We are hoping that they come it's 2:00. We're closing at like 3. So we don't have them yet because they haven't tendered them. So if we get it and all of a sudden there's a huge issue on here that's just disclosed now, that allows your client to cancel the contract if they disapprove of it. And you're supposed to be acting in good faith. So it shouldn't be something minor, but there's a lot of surprises on those documents sometimes.
Right.
So does that answer the question?
It does. I think it answers it very well. And one last question I have, Jill, who is, someone wanted to know, who is ultimately responsible for providing all these documents that could be asked for or actually have to be disclosed on the 22.1?
Well, the responsibility is for the seller's attorney or the seller themselves to order these documents, but who's going to prepare them would be the association responsibility. And it's really, where you talk about having a management company, a lot of those will be ready to go.
Right.
And it really goes back to the board and to the association to prepare that 22.1. And sometimes people don't know how to answer it. And that's where I think, being self-managed can, have a lot of questions for you and a lot of, when you see that for the first time, let's say you haven't had any units sell, for 3 or 4 years, you've been on the board for a year and you get these, you're like, what's the 22.1? I don't even know how to answer that. It can be a little much for the incoming board. So I think, having direction from professionals is really key for the board.
Right.
Hey, Jill, one question to go along with that. Have you ever had with a special assessment that's in process when somebody's selling it and it hasn't been disclosed for some reason, it got missed? And what happens if that does happen?
Well, it would come on the paid assessment letter. So it would be that's when the association tender. So we have the 22.1 to disclose everything. And the paid assessment letter is just a statement from the association that says, all dues are paid in full. There's no special assessments or, you have paid, we're closing, it's September 17th. So we're closing today. They've paid in full through September 30th. The next payment for the assessment is due October 1st. Here's who to make the payment to. The other section that it'll address are there any, because I wouldn't want to close for my clients if it didn't address in the paid assessment letter, there's no pending special assessments. So nothing's owed from this current seller to the association. And that's where, when we talk about for your seller, that can be a big surprise.
I would like to thank everybody who participated on this panel. I hope that if the viewers get a chance to express some thoughts to CAI, how you like these type of educational seminars, please do that, because obviously the more you like them, the more in the future they could occur. Thinking as a member of the education committee, feedback is important to me, and I'd like to enhance that in the future. But I really want to thank Steve Silverman, who is a very seasoned accountant, Jill Daniels, who is obviously an extremely well-versed attorney with very much experience, and Peter D'Angelo, bank president, who has been very involved with CAI in Illinois for a long time. I think you three have made a very robust panel today, and I really appreciate your contribution.
Thanks, John.
Yeah, thank you.
Thank you. Thank you all for attending. Brandon, back to you.